market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Donald Trump has defended his plans to dramatically increase tariffs and seek greater influence with the Federal Reserve if he returns to the White House. Now, the Republican presidential nominee has been speaking to Bloomberg News editor-in-chief John Micklethwait.
We're all about growth. We're going to bring companies back to our country. To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm. I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un.
You worry about that?
The dollar is so secure. Your reserve currency is the strongest it'll ever be. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do.
Well, with me now, Bloomberg's EMEA News Director Rosalind Matheson and Hugh Gimber, Global Market Strategist at JPMorgan Asset Management. So thank you both for joining us. Ros, we had this 1 hour long interview that our editor-in-chief did with Donald Trump. What did we learn in terms of his economic outlook?
Well, it's interesting to see the conversation. Obviously, he was talking primarily to a domestic audience with just weeks before the election. It's a compelling argument that the US has for years been taken advantage of by other countries around the world, that he would bring more of that business back. He would protect US companies, US jobs. That's what he's been talking about, obviously, when he was president previously and now as a contender. Of course, the reality is that putting major tariffs on countries overseas and companies overseas can do, detrimental effects on the US economy. We've seen that in terms of questions about how much revenue it brings in, what it does to inflation, what it does to economic growth. So really not clear it's going to benefit the US worker, the US companies in the longer term. But that messaging is, again, very clear that Donald Trump, what he sees around the world is everybody's a competitor. It doesn't matter if you're an ally. It doesn't matter if you're an adversary. In fact, he said in the interview yesterday that our allies have taken more advantage of us than our enemies. And that's a clear sign if he becomes president again. Watch out if you're the EU, not just China, but, countries within Europe and so on.
And it seems now that actually both candidates just try and talk about the economy in the swing states. And what are the polls telling us?
Well, the polls are so tight. I mean, even polls today show, again, they're basically neck and neck. Everything is within the margin of error, including in those swing states. You heard Donald Trump name, the key states, including Pennsylvania in particular, is going to be the one to watch on the night. But what it tells us is that voters are still either not telling people who they want to vote for, or they're really not sure who they want to vote for. And it's still anyone's guess how that's going to show up on the night. But absolutely number one issue, really, when it comes to voting, we know this in every country around the world, tends to be the economy. And there's very little daylight between them on that front.
So, Hugh, when you look at, the Trump trade, how do markets position themselves ahead? Again, it's an election that's too close to call. It's maybe 200, 300 swing voters that will decide the outcome. Is a Trump trade, does that have automatic implications for dollar strength and treasuries?
So this is all through the lens of inflation for me. When you think about the key areas where policy can move, tax cuts is one, tariffs is two, and then a restriction on immigration is the third. All of those could lead to a slightly more inflationary mix moving into 2025. You look back at how the US has achieved its inflation target, not just over the past few months in terms of inflation coming down, but really over the past couple of decades, it's been via zero goods inflation. You paid the same for a basket of goods in the US in 2000 as you did in 2020. If we're going to see this more confrontational stance, as Ros mentioned, this sort of move towards competition against every trading counterpart, it feels very unlikely to me that we're going to be able to repeat that same kind of outcome with very, very low levels of goods inflation. So, to my mind, this isn't an election to pre-position for. As you say, this is looking incredibly tight, but we see a wider range of potential outcomes for Treasury yields into next year than we do in, say, UK gilts or particularly German bunds, where fiscal missteps have already been made.
Can he really continue with reshoring? I mean, a lot, if you look at the charts, a lot has already, manufacturing has gone back to the US. And actually, what does it mean for U.S. exceptionalism longer term?
So So US exceptionalism is built around excessive fiscal policy, right? We're already running a 6-7% fiscal deficit. You look at where the deficit will be headed if we do see tax cuts that are due to expire at the end of next year extended. I think this is often the piece that investors are missing. People point to the weakness in Europe, the weakness in emerging markets, and talk about how the US economy is just the standout. And the piece that we miss here is that it's being built on, frankly, unsustainable levels of debt. In a normal election cycle, you'd be looking at this debate and expecting a much clearer focus on how either side is going to try and fix the hole in the federal finances. And instead, we have this scenario where both sides of the aisle are looking for more expansive fiscal policy next year. So this isn't a clear call for higher Treasury yields. Ultimately, inflation will be the driver, but I do think it gives you a much wider range of outcomes.
Yeah, and of course depends on what happens with, of course, the houses. Rozar, John Micklethwait also asked him about the potential replacement of Jay Powell. This is what Donald Trump had to say.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all.
I mean, it's a little bit more complicated than that. It's not a government job. I mean, Jay Powell works pretty hard. He was also a Donald Trump appointment, Roz.
Well, that's right. It's interesting to see. He was saying on the one hand he feels he should be able to pick up the phone and talk to the head of the Federal Reserve. But at the same time, it's not him to make the decisions about it. And that really is kind of creeping into that area for markets of unease about the level of intervention that you might get again. I mean, saying that he felt that rates were in the wrong direction when he was previously president, and then Powell overcompensated by, saying that he was alluding to the fact that he believed that Powell reacted to what Donald Trump was saying, whereas I'm sure Jerome Powell would say that he made decisions about interest rates based on the status of the economy and the economic outlook solely at the time. But we know, we've seen that from Donald Trump previously as president. We presumably would see it again, and that's that real level of sort of interventionist behaviour around all kinds of institutions in the US, economic or otherwise. You talk about the courts as well. I mean, all the different levers of government administration where you get that idea of separation of church and state. Donald Trump doesn't really believe in that. He believes he should be able to pick up the phone and talk to whoever. We see that even with his comments about whether he feels it'd be right to talk to Vladimir Putin from Russia, at a time that Russia's at war with Ukraine. So certainly those kind of separations would not exist again if he were to win the election.
Hugh, did the markets sit up and take notice of talk about, I mean, it's not really putting in question the dependence, but actually it's skirting around that?
It all comes back to the economy, because if the economy is holding up fine in 2025, if growth is still ticking along, if inflation's coming somewhere close to target, I suspect if it is a next Republican administration, they'll focus their guns elsewhere. They'll be thinking more about tariff policy, around the potential for passing a big tax bill. And I suspect they'll be happy to leave the Fed and let them get on with their job. I think it's under the scenario where the economy cools more quickly next year. If you do see the US slipping into recession, that things are likely to get noisier. Either way, there are checks and balances here, right? There has to be good cause for the president to try and intervene. One of the things that President Trump also mentioned last night was that while he'd like this communication, he still thinks that the president shouldn't be able to control what the Federal Reserve does. So we've heard lots of this before between 2016 and 2020. Ultimately, the Fed stayed independent then. I would expect the same to happen this time round.
Thank you both. Ross Matheson, there, of course, our EMEA News Director, Hugh Gimber, stays with us. Now, coming up, chipmakers plummet after ASML misses estimates. We look at whether it's the start of a wider slowdown across semiconductors. That's next, and this is Bloomberg. Welcome back, everyone. We talked at length, of course, about Donald Trump. We talked at length about some of the concerns surrounding independence of the Fed. Now, the other big story today is UK inflation dropping below the target of the Bank of England. That definitely, and we've seen it in money markets, is boosting a case for a rate cut. So let's get back to Hugh Gimber, global market strategist at JPMorgan Asset Management. Hugh, this is big news. I mean, if you're like a BOE watcher, you're like up and down in arms. I mean, what does it mean for, if you look actually at the fundamentals of this economy, I was always quite surprised that it was pushing back cuts mainly into next year. And I don't know whether that was because of wage negotiations. But does that change your perspective for BOE?
No, it doesn't, is the short answer. So when you look at why inflation fell so sharply today, it's parts like airfares, it's motor fuels. These are the things that are really outside of the Bank of England's control. Go back to yesterday's data with the labour market. Wages, yes, are cooling, but they're running at close to 5% year over year. That is inconsistent with the Bank of England's inflation target. So I think today's print nails on the November cut, but it is too early to start thinking about even meeting-by-meeting cuts, because the labour market is in just such a different position in the UK to the US or to the Eurozone that I still think the Bank of England would be taking a big risk if they feel now they can move into lockstep with the Fed and the ECB.
So how many cuts are you expecting?
So quarterly, I think, is the right base case looking out into 2025. That's still, gradually acknowledging that inflation is moving closer to target. But I think there's more work to do. The bank may well point to measures such as their super core and the different definitions that they're using. But there's always a danger here. Basically, if you strip out everything in the inflation basket that's going up, then no wonder the measures that are left are going to be going down. And so I think prudence is called for in the UK. If we were seeing a stronger recovery in terms of labour participation, that would be cooling wage growth, but that's simply not happening. Participation is still falling, unlike the US, unlike the Eurozone. So naturally, the temptation for the BOE to start thinking, oh, yeah, maybe we can keep pace with the pack here, is going to be building. But that comes with risk, because the UK economy is just in a different position.
What about the ECB? So we're expecting, of course, a cut on Thursday. Again, they have quite a lot of things that they're worrying about, notwithstanding inflation picking back up.
Yeah, I mean, the case for the ECB to be gradual is dead, in my view. They're talking about data dependence, but the data is sending a very clear signal that rates need to come down. They're in a very different position to the Bank of England. Look at manufacturing new orders in the Eurozone, 42.2 at the moment. This is an economy now which is crying out for lower rates, because in terms of China, there's no imminent boost coming. In terms of the squeeze on autos, this is a sector which is experiencing not just cyclical challenges, but structural challenges. So for me, I think anything but a 25 basis point cut tomorrow would be a big surprise. But this is where we expect the guidance to start to shift towards that meeting-by-meeting pace, because the Eurozone simply needs lower rates now.
But is there a danger that there's higher inflation, which I know has come down, but could resurge, given all the geopolitics, with the lower growth rate, borderline recession?
I think that's less likely, and it comes back to the composition of the labour market. Eurozone wages are much more of a lagging indicator because of the very high level of unionisation. So this is more about the unions demanding compensation for inflation that's in the past. And so as headline inflation continues to cool, we're frankly less concerned looking at the Eurozone labour market and worrying about those second-round effects of sticky wages leading to persistent services inflation. So headline's going to be buffeted around, but it's the core inflation pressures that are moving back. And when you have such a more manufacturing-dependent economy, the manufacturing sector is where you would expect those rate cuts to be felt. So I think the case for the ECB is clear.
Chips are getting slammed. We heard it from ASML. There's also, of course, concern about the trade war being ratcheted up. We had a story yesterday about the Biden administration actually forcing NVIDIA to not sell to certain countries. And luxury is also being slammed. I mean, what's this earnings season going to look like?
So for me, this earnings season tells us there is more to life than mega caps, right? You look at the leaders this year, all of the popular names so far, I mean, ASML, LVMH are two good examples here where expectations have been built up, and there are multiple factors weighing on these companies. You look at some of the broadening out, though, that we're seeing, and this for me is an encouraging factor that sector returns are becoming much more evenly distributed. That's a healthy thing for the stock market. Go back to Q1 of this year, you had the Mag 7 in the US doing about 50% earnings growth. Everything else was in negative territory. By the end of this year, we think both of those segments are probably growing somewhere in the region of mid-teens. So for an index investor, that's a challenge, right? Because you have this rotation leaving you potentially standing still. But as the earnings start to broaden, that's the catalyst that we've been waiting for a long time, to start to see the gap in valuation that's been built up begin to gradually close.
Hugh, thank you so much for all of your insight. Hugh Gimber there, a global market strategist at JPMorgan Asset Management. Now, coming up, ASML, as we were saying, those shares continued to fall after missing estimates. We'll look at how curbs on the chip industry are hitting the whole sector. This is Bloomberg.
From Nvidia to ASML, Tokyo Electron to TSMC, the highest of high-tech chip firms are caught, ever more directly, in the geopolitical crosswinds between Washington and Beijing. The stakes could hardly be greater, with America and its allies increasingly fearful of Chinese advances that might give it crucial technological and military advantages. From design by the likes of ARM and Nvidia, to equipment from lithography powerhouse ASML, to materials to make the chips from the likes of Global Wafers, and manufacturing by the foundry giant TSMC, the global supply chain winds through many countries considered geopolitical hotspots. US attempts to box in China haven't always been successful. And it's not just the parts themselves. The Netherlands has curbed ASML's ability to maintain its high-end lithography machines in China, which could render some of them inoperable next year. Still, with such vast and intertwined supply chains, slapping restrictions on high-tech is harder than it looks. And then there's the risk of Chinese retaliation.
Well, Bloomberg's Tom McKenzie reporting there, and Tom is here to talk ASML shares in the Dutch chip equipment maker down again after falling the most in 26 years. Investors pretty spooked about the news that it booked not enough orders compared to what it was expected. Tom, what's going on? I mean, chips are getting slammed.
They really are. So this has, to your point, has that ecosystem impact, that impact across the chip sector, because of concerns of what this tells us about, one, AI demand, and also more broadly the demand around, for example, autos chips and industrial chips. And I'll get into that in more detail. But the top line is they came in with orders well below the expectations, less than half. So 2.6 billion euros was the orders for the most recent quarter. The expectations had been they'd log 5.4 billion euros, so less than half. And they downgraded their forecast as well in terms of the forward guidance for 2025. So they now expect sales of between 30 to 35 billion euros. They had expected 40 billion euros. The newly installed CEO, Christophe Fouquet, saying the recovery is more gradual than expected, and that will continue in 2025. Customers, he says, are cautious. He says there is potential for some upside around AI. So he wasn't dismissing the gains that could come through from AI, but he really pointed the finger of blame at the industrial demand, the autos demand, and said that customers like Intel are cutting costs, and that's having an impact.
And China's not doing as well as expected.
Absolutely. So, of course, we know about the broader impact in terms of the macroeconomic picture of China, which, of course, remains challenged. And then there's the fact that you have these additional restrictions put in place from, of course, the US. Look, this is still a company, ASML, that gets 47% of its sales from the Chinese market. Into 2025, UBS analysts think that they could lose up to a quarter of their sales in the Chinese market could be lost as a result of some of these restrictions. Again, that's according to analysts from UBS. So they face vulnerability in terms of their exposure to China. They still ship into China some of their equipment, just not the high-end kit that is now blocked by restrictions. Further restrictions could mean fewer sales into China at a time, of course, of weakness in that economy anyway. What we're going to be listening for, the call is later today. They're going to be scrutinised in terms of what's happening in terms of the demand for the high-end stuff and what they think about that AI picture as well.
So important. Tom, thank you so much. Bloomberg Daybreak Europe anchor Tom McKenzie. Now, coming up, we're joined exclusively by the president of the European Bank for Reconstruction and Development as it announces its largest single foreign direct investment in Ukraine since Russia's invasion. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Shares in the chip equipment maker ASML tumble again after falling the most in 26 years on weak orders and guidance. Luxury giant LVMH also plunges after sales drop for the first time since the pandemic on cooling demand in China. Plus, Donald Trump dismisses criticism of his plans for more tariffs, speaking to us just 3 weeks before the U.S. election. So let's stay with that story now. And Donald Trump says his policies will boost growth and bring companies back to the U.S. despite economists predicting otherwise. Now, the Republican presidential candidate says he'll offset trillions of dollars of tax cuts by raising tariffs on imports. Well, he spoke to Bloomberg News editor-in-chief John Micklethwait.
Because we're about growth, she's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in, because we're not going to have somebody undercut them.
Donald Trump also declined to say if he had spoken to Russian President Vladimir Putin since leaving office in 2021.
Well, I don't comment on that, but I will tell you that if I did, it's a smart thing. If I'm friendly with people, if I have a relationship with people, that's a good thing, not a bad thing, in terms of a country. He's got 2,000 nuclear weapons, and so do we. China has a lot less, but they'll catch us within 5 years.
Meanwhile, Ukrainian President Volodymyr Zelensky says he'll present what he calls his victory plan to his country's parliament today. Now, Zelensky has been seeking fresh aid from his European allies amid fears of dwindling support if Donald Trump wins the U.S. presidency next month. The European Bank for Reconstruction and Development has also announced its largest single foreign direct investment in Ukraine since Russia's invasion. Now, together with the International Finance Corporation, it plans to provide $435 million in long-term debt to one of the country's leading telecoms group. Well, we're now joined exclusively by Odile, Renaud-Basso, president of the EBRD. Also with us, Bloomberg senior writer Stephanie Baker. So thank you both for joining us. Thank you. When you look at what Madame Renaud-Basso, what the EBRD has said, I mean, this is a large chunk of investment that basically goes into fiber optics. I mean, how is it so important to rebuild some of the infrastructure, especially infrastructure that loses less energy still in the time of war in Ukraine?
So it's very important because having a foreign investor putting such a big amount of money in Ukraine is a very strong sign of confidence. So that's the first element. The second one is on the technique itself. Bringing together a mobile telephone company and a fixed telephone company will bring a lot of benefits, and the company will start investing more to develop the network, improve the energy efficiency, improve the cyber security, and so forth. So the investment will benefit 10 million of people in Ukraine. And as we know, having strong telecom communication tools is very important in a war situation for the business to be able to continue, for people, and for the country itself. So it's a very positive news.
Odile, how difficult is it to do this in again, an active war? Because you don't know, things can be hit, you have to go back. How difficult is it to find the money?
So it took us a lot of time. We started a discussion with the investor, the French investor, before the war, so in 2021, before the war started. Then it was suspended at the beginning of the war and then started again, and it took a lot of time to build the package. But there we are, and I think it's very, very good news.
Stephanie, I have so many questions. I mean, the interview that John Micklethwait did with Donald Trump yesterday probably means that we don't fully understand whether he did speak to Vladimir Putin after he left office or not. But what do we know if President Trump, is in the White House come January 20th? What will he do with Ukraine and Putin? What do we know?
All we can do is go off of what Trump has said he will do. He wants to end the war. He says he can end it in a day by talking to Putin and talking to Zelensky. J.D. Vance has outlined more details, but it does look like they would declare a ceasefire, cede control to Russia of Ukrainian territory, and possibly lift some sanctions as an inducement. Now, whether or not that would work, whether or not Putin does not seem like he's ready to stop fighting. So I think it's a lot easier said than done. And I think there's obviously real concern in Ukraine that they will be abandoned and that either way, whatever deal might be done, that they will not be receiving the amount of U.S. aid that they have so far.
Will it be more difficult to find that money in Europe, given that they potentially also have to deal with the tariffs coming from the White House?
Well, I think Europe has stepped up and will step up financially, but it doesn't have the defense base to provide the amount of military aid that Ukraine really needs. It really needs the U.S. involved. And I think that is going to be a major challenge, that even if Europe is able to provide additional financial aid, where is it going to... Already, we're facing low stocks, both in Europe and the U.S. So I think that's a real question mark going forward.
Odile, we spoke last month, again, about the long-term reconstruction plan of Ukraine. Again, very difficult when it's still an active war zone, so you don't know how long or what will be needed in 2-3 years. But what are some of the key sectors that you're also working on?
No, I think what is very important, first of all, is to secure the financing for 2025. And the good news is that Europe has decided on mobilization to 35 billion euros. Is already, in macro-financial assistance to support the budget. And I think there is a lot of discussion with the US ongoing on how to implement, the mobilization of the revenues from the frozen assets. So that would secure 25, and is very important. And for us, for the reconstruction, so continuing to work on the infrastructure, rebuilding of the key infrastructure. The energy sector remains one key challenge in the short and medium term, but also manufacturing capacities and so forth. The good news is that the exports, thanks to the agreement on the Black Sea and the situation with the Black Sea, have increased again. And Ukraine has some external revenues related to export in agriculture and manufacturing products.
Yeah, so you deal, of course, with rebuilding Ukraine, but you need the package also to defend Ukraine. Do the two come hand in hand?
I think they have to. And, as I went into in my book, Punishing Putin, that this whole debate over using frozen Russian sovereign assets is really key. As she said, they have figured out a way, Europe at least, to leverage the interest payments from that pot of money in Europe for this 35 billion euro loan, but the U.S. needs to step up as well. And I think there'll be increasing pressure on using those assets in a greater way to try to aid Ukraine. The costs of rebuilding Ukraine are enormous, and so projects like the EBRDs are really important in terms of signaling to other investors that there's confidence and providing the infrastructure that they need to go in.
How much of this is also private money, or how much money will you need from the private sector?
A lot of financing from the private sector will be needed. Now it's difficult, but we see it's possible with the project we just financed in the telecom, but more will be needed, and more will come when the situation will be clearer in terms of war. But, overall, our contribution up to now has been 5 billion since the beginning of the war, which is already quite a large input. And I think that the connection between supporting the macroeconomic, the budget situation, and the military is very important. One positive news also is the fact that the Ukrainians have developed their own capacity, military production capacity in drones and so forth, and they have some technological skills, which is helpful. It doesn't sort everything, but it's an important contribution.
I mean, one of the main stories that we're also trying to focus on is the expiring gas transit deal. That feels very significant, like gas transiting, through Ukraine. Does that change everything?
I mean, it could change a lot, and then there are a lot of discussions around that because some countries in the EU are still very dependent, like Hungary, Slovakia, and so forth. So there is a lot of discussion around this issue, which is, of course, is quite strategic.
Stephanie, do people care? And I think we've talked about this in the past. Do people in the U.S., when they go and vote on November 5th, do they care whether, Donald Trump spoke to Vladimir Putin once he left office or not?
Obviously, foreign policy is not the major factor in U.S. elections, but given the prominence that Putin has played in U.S. elections over the past 10 years, I think it could influence the continuing doubt over Trump's relationship with Putin is a worry and is an attack line that Kamala Harris can use to go after Trump. And the fact that he's waffling on this. Last week he said he denied this report by Bob Woodward that he'd spoken with Putin and said that it was, Bob Woodward was just a storyteller and a bad one. Now he's refusing to say yes or no, and he didn't deny it yesterday, which I think is significant. It only deepens the sort of speculation about what really went on, what did they say, did they talk, and about what.
Thank you both for joining us. Odile Renaud-Basso there, president of the EBRD, and our very own Stephanie Baker, who's also the author of Punishing Putin. Now, coming up, we're in the middle of earnings season for the Wall Street banking heavyweight, so we'll break down the numbers next. This is Bloomberg. Welcome back, everyone. Now, Citigroup shares disappointed during Tuesday's trading session, despite its traders turning in its best third-quarter performance in at least a decade. Now, it was among some of the big U.S. banks that reported earnings yesterday, with Goldman Sachs and Bank of America. Later today, we'll get an update from Morgan Stanley. I'm delighted to, of course, now talk to Charlie Wells and Paul Davies. Paul, you have a great, thank you both for joining us, but you do have a great piece that we need to get back on, saying Wall Street bonuses have just been salvaged. So I know a lot of people watching from the trading floor will probably be like, whew, I'm so glad he wrote that. But Charlie, what seems to be the driving force behind these banks?
It's really interesting. There were some positive earnings calls yesterday, and when you tuned in, you could hear the CEOs talking about how good they feel about the economy right now, especially when you listen to Jane Fraser of Citigroup. She said, whatever you want to call the landing, it's positive. David Solomon at Goldman was talking about, increased optimism for a soft landing. So that was one element. You also have this lower rate environment that we seem to be going into that is looking like it's going to spur more activity. That's great for banks. And then also volatility. More people want to trade when things are more volatile.
So, Paul, we had this unexpected boost, right, deal-making and trading activity that came late in the third quarter. First of all, why? And what does it mean for the prospects for next year and bonuses?
Yeah, well, so it's quite interesting. There was a bunch of warnings from the different banks about, their revenues and what they were going to look like earlier in the third quarter. And then, like you say, we did get this late boost. There was a bunch of strategic deals that were brought forward and closed early. Debt capital markets, bond issuance has been the thing that's been, going great guns all year. And we saw a whole wave of that as well. I mean, I guess, the issue is that some of this stuff might just be robbing activity from the fourth quarter. But like Charlie was saying, the CEOs, particularly at Goldman, were very positive about, the pipelines that they have, as they always are. But, they were very positive about the amount of
this time for real.
More strategic activity coming through, in the fourth quarter and into next year. And obviously a lot will depend on the election, but it seems like there's kind of real M&A building.
But, Paul, I mean, Citigroup also had this massive overhaul. I mean, they brought in, the JPMorgan's biggest banker in London. So is it always also a testament that, things are working there, or is it too soon to tell?
Well, it's very interesting, Citigroup. I mean, in many ways, it looks like they've turned the corner in terms of generating better revenue, especially in the markets business and the investment bank, really good numbers compared to what they've been clocking recently. But at the same time, they're still kind of struggling to sell the story on expenses. They had this kind of weird moment on the analyst call where Mike Mayo was asking them about whether they're going to have an asset cap or not, which I think all fed into the share decline. And they obviously kind of, went backwards on their returns on equity as well slightly, which, is always going to worry investors a little bit.
What are we expecting from Morgan Stanley?
This is going to be an interesting story. So Morgan Stanley, of course, very positioned in wealth management. And, the boost in equities could be, a great story for them to tell there. What a lot of analysts are going to really be looking at with Morgan Stanley is cyclicality. So a lot of the other huge banks have been able to kind of tell the story of, whatever environment we're in, good or bad, we're able to make money. Can Morgan Stanley tell that same story? It's looking like they might take a hit on net interest income. It's looking like investment banking will be great for them now, but how do they become a sort of all-weather bank?
And Paul, how are things, changing for a lot of the big financial firms? So some of the big asset managers are also looking at private credit, private credit, private equity, hedge funds. So what does it mean for the banks?
Well, so this has been, a great business for the banks in recent years, particularly in their markets businesses, and they've all been focusing on, as they try and compete against the, the execution businesses of Citadel and Jane Street, Citadel Securities, I should say, and Jane Street and all those people. They have been trying to do more financing of their big clients, and as private assets have grown, as exits have been more difficult, and they've found it harder to get money back to their own investors. The banks have stepped in, found new ways of lending more and more money to private equity, to private credit, and also to the big multi-strategy hedge funds that have been growing and taking on a lot more leverage as well. And that's been visible in Goldman's, financing numbers in its market business. Less visible, but we know it's there in Bank of America's markets business as well, and in JPMorgan and across the street. And they've all been doing very well off of that.
What does it mean for pay? I mean, I read, it wasn't our own opinion column, but something, about interns at, for example, Jane Street being paid more, I think, than Jay Powell. I mean, do you see it in some of the bonuses, the difference, depending on what part of the financial sector you're in?
Yeah, I think so. I mean, I think, obviously it's going to be it's been a better third quarter than lots of people expected in markets. I think it will be a better full year than lots of people expected in markets for the investment banks. Their pay isn't going to go off the charts. And, and when you're talking about Jane Street and Citadel Securities and people like that, they have far fewer people handling much larger volumes of business because it's all about computers and technology and so on and so forth. So, perhaps they probably will continue to get paid better than almost everybody else.
Okay, so interesting. Thank you both for joining us. Charlie Wells and Paul Davies joining us on the banking sector. Now, don't miss our interview today with Ted Pick, the chief executive at Morgan Stanley. That's at 3:30 p.m. UK time. Coming up, we talk luxury. LVMH sales fall for the first time since the pandemic. We look at why the luxury goods maker is failing to catch the eye of Chinese consumers. This is Bloomberg. Now, the AI boom has caused demand for energy to surge globally. Google, Microsoft, and Amazon are turning to nuclear power as an energy source for data center. Well, we discussed AI's environmental impact with Estelle Brachlianoff, the chief executive of the world's largest environmental services company, Veolia.
AI can be part of the solution and is a problem at the same time. So if I start with the problem, AI data centers, they consume a lot of energy and they need a lot of water. So actually we're providing services to the companies which are doing AI, and it's a growing market. On the other side, AI can benefit ecological transformation and saving water, saving energy, saving CO2 and so on and so forth. And can make a company like Veolia more efficient.
Well, you can watch the full interview of Leaders with Lacqua Goes Green, airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now, staying with French corporates, and LVMH shares have continued to tumble in early European trading after the luxury goods giant missed estimates with its third quarter earnings. Well, Bloomberg's Andrea Felsted joins us with the very latest. Andrea, you were ahead of the curve. You said, there's going to be a pricing problem, especially if China's so weak. What did we learn on LVMH?
We learned that there has been a real slowdown in China. Now, LVMH played down the impact of pricing but obviously prices have gone up a lot over the last 5 years. That China weakness is really a problem for the industry.
So who's doing well and who's not?
Well, I was surprised how weak LVMH was. They are one of the stronger names. I think when we get the slate, the full slate, they won't be at the top, but they won't be at the bottom. I think Hermes is still very resilient. Prada's having a fashion moment. They'll probably be the leaders.
So, Andrew, when you look at, I guess, the bad news that has been coming in because of China, because of a number of other factors for luxury, are we near the end of the bad news?
We're probably nearer to the end than the beginning. If you think luxury started slowing a year ago, things really deteriorated over the last 3 months, but they really did start to slow. It was a lot of talk about normalisation. Plus, we've got the China stimulus coming in. And LVMH also said they'd seen a slight improvement in the US and in Europe.
So going forward, I mean, what do you look at? It's not really a barometer of how the consumer or how, it's not really a recessionary barometer, but it gives us a good indication of how people are feeling.
It does, but also I think there have been a few own goals from the brands as well. The pricing, obviously. There was that big move to quiet luxury. It's a bit dull. They really need to, LVMH talks about product innovation, reviving, the desirability of products. If you look, there's been quite a lot of change at the top of its designers. That all indicates they are trying to sort of, really reignite the brands, re-energise them, to give consumers a reason to buy. Don't forget, we all bought a lot. In the pandemic, couldn't go on holiday, couldn't go out for dinner, we bought luxury goods, probably haven't needed another new handbag. So there really is a reason, you need a reason to encourage consumers to buy now.
Andrea, thank you so much, as always. It's also interesting the fact they're trying to get more aligned with some of the sports, right? So be it Formula One or the Olympics for LVMH. Andrea Felstein there from Bloomberg Opinion. Up next, Bloomberg Brief, Danny Berger in New York, and this is Bloomberg.